Well, congratulations to Channels Television and other awardees from that event. We're going global now. We're starting with President Trump. His administration is stepping up pressure on Iran with a new plan to cut the country off the global economy. The Treasury Secretary Scott Bessent says that Operation Economic Outcast, that's what they've called it, that it will target countries and companies that help Iran move money, sell oil, or access international markets. Washington also signals that China will not be exempt, raising the risk of further tensions between the world's two largest economies. The move comes as the U.S.-Iran conflict approaches 6 months, with diplomatic efforts showing little progress. Reacting to that, global sovereign debt market settled into a quiet holding pattern on Tuesday as a pullback in crude oil prices and new potential of cash funding adjustment in Washington has helped cool borrowing costs following weeks of intense duration volatility. The policy-sensitive 2-year yield eased to 2.852%, while the benchmark 10-year bond that inched up 3.249, remaining anchored near multi-year highs. France's 10-year yield that was flat at 4.117, while Italy's 10-year BTP yields similarly stabilized at 4.080. The calm across Europe rates curves follows a tumultuous stretch driven by expanding sovereign deficits and persistent energy inflation, with trading desks taking advantage of a breather in commodity markets to reevaluate central banks' policy paths. The primary driver allowing debt markets to catch their breath as a double dose of geopolitical and technical relief out of Washington. And still reacting to that, European stocks are rebounding. Concerns over the impact of potential Iran sanctions that has started fading. Investors are responding to signs that the threat of broader economic disruption may be less severe than previously feared. The recovery comes as markets continue to assess geopolitical risks and their potential impact on global trade and commodity prices. And still with the United States, they're considering a 7.5% tariff on some Chinese goods over concerns about industrial overcapacity. The move comes ahead of Chinese President Xi Jinping's expected visit as Washington seeks to address trade imbalances while managing tensions with Beijing. The proposed tariff could add to pressure on Chinese exporters and further complicate U.S.-China trade relations. Away from all of that, German gross domestic products, that went up today 0.3% in the second quarter of 2026 from the previous quarter, beating the 0.2% consensus forecast, driven mainly by export. This is according to the Federal Statistics Office. The reading was below 0.4% growth recorded in the first quarter of 2026, which was itself revised up from an initial estimated 0.3%. The office detailed results showed a second quarter growth was 0.1 percentage points higher than the 0.2% reported in its first release on July 30. And total exports of goods, services, and services rose 2% from the first quarter, led by a 2.6% increase in exports of goods, while imports rose 1.5%. The gross fixed capital formation, that dropped 0.2%, with capital formation in machinery and equipment down 1.4%. Final consumption expenditure rose 0.1%, with both household and government spending up 0.1%. The gross value added rose 0.4% after adjustment for price, seasonal, and calendar effects, with manufacturing up 0.9%. Still around Europe, shares of Air France KLM rose 2% in early Paris trading after Kepler upgraded the airline to hold from reduce, saying the stock has reached its 11.50 euro price target and is now fairly valued. The broker downgraded the airline to reduce after about a month, when it viewed the share price as somewhat ambitious following the start of the Iran crisis, Since then, shares have dropped about 12% and are now in line with Kepler's target price, absent a material escalation in the Iran crisis. And they believe that the current share price accurately reflects the company's business prospects. Lego is reporting record revenue for the first half of the year, supported by strong sales across both premium and more affordable products. The toy maker says consumer demand remains strong despite pressures on household spending in some markets. The performance highlights Lego's ability to attract customers across different price points. And South Korea's leveraged ETF market is seeing a sharp reversal, with investors pulling out about $1 billion as the speculative frenzy loses steam. The outflows come after a major stock market sell-off that has hit retail investors hard, with leveraged products amplifying losses. Regulators have since tightened rules around these high-risk products as investor confidence weakens. And finally, Japan's only high-speed trading firm, the Pharma Capital, is moving its operations to Singapore. The relocation underscores the city's growing appeal as a hub for high-frequency and algorithm trading. The move also reflects Singapore's role as a key financial center in Asia, attracting specialist trading firms and global investment businesses.